Good afternoon, everyone. This is Chuck South, Chief Investment Officer for iSectors. I'd like to thank you for joining us today for the iSectors fourth quarter 2015 performance updates. I will be providing a brief fourth quarter performance overview of all the iSectors models and conclude with our near-term economic perspectives on the market. This call shall last about 10 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box on the right-hand side of your screen. This presentation will be recorded and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar participants immediately after this call. Post-MPT allocations underperformed their benchmarks in the third quarter. Post-MPT lagged due to energy and bond holdings. Both strategies benefited from technology and financial allocations. As the chart on slide 3 indicates, post-MPT growth continues to experience a shift in its allocations. The model continues to significantly de-emphasize stocks. Almost all the stock positions owned are in technology and utilities. You will also note that the allocation continues to shift into bonds. In fact, the allocation's investment in U.S. Treasury bonds stand at its highest level since early 2012. Since the strategy's benchmark is the Standard & Poor's 500, the model is indicating that Treasury bonds is currently the most attractive asset class. iSectors post-MPT growth continues to outpace other ETF strategies. We're pleased that the allocation is ranked 4th among all 486 ETF strategies for 5-year performance and 10th out of all 185 strategies for 10-year performance in the Morningstar ETF Managed Portfolio database. We expect post-MPT growth to continue its reputation as one of the premier allocation strategies utilized by investment advisors. Besides post-MPT growth, a number of our allocations were negatively impacted by declining energy prices. Endowment could not keep up with this benchmark, while liquid alternatives outperformed hedge funds. The supply-demand balance in the energy market continues to be elusive. As the chart on slide 4 shows in black, energy stocks, including master limited partnerships, were in decline for much of the fourth quarter. The chart also plots in red the positive returns earned by our timber ETF. The listed private equity holdings also gave positive results to these allocations. Both allocations are broadly diversified and should recover when the commodity markets stabilize. In the meantime, it should be noted that liquid alternatives have outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of over 3%, liquid alternatives should be considered for diversification as equity returns ease. Domestic equity again outperformed global equities. While both allocations benefited from an emphasis in dividend stocks, which are now outperforming growth stocks, small and mid-cap holdings underperformed the S&P 500. The global fixed income allocation was negatively impacted by high yield weightings in the quarter, while Treasury inflation protection securities, or TIPS, and floating rate bonds benefited from the rise in short-term rates enacted by the Federal Reserve in December. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most ETF strategies. In fact, the domestic equity allocation is ranked 9th out of all 486 ETF strategies in the Morningstar database for 5-year performance. iSectors is proud to be the only investment manager to have 2 strategies, post-MPT growth and domestic equity, in the top 10 of all ETF strategies over the past 5 years. Metal markets weakness and volatility continues to strongly affect our inflation protection and precious metals allocations. Precious metals continued its decline on the backs of falling silver and palladium prices in the 4th quarter. Thus, as you see in the chart on slide 6, for the Central Fund of Canada, which holds gold and silver bullion, the fund had a greater than 15% decline from mid-October to mid-December. Broad commodity, particularly energy holdings, negatively impacted the inflation protection allocation. Inflation protection's drop was tempered by its real estate and timber exposures. Although this is a webinar to review 4th quarter performance, you will want to know that the inflation protection and precious metals allocations had positive returns in January. As we discussed last quarter, a 10% to 20% allocation to precious metals, inflation protection, or liquid alternatives will be worthwhile given our view that the next 5 years in the equity market will not be as profitable as the last 5 years. As the chart on slide 7 indicates, capital preservation has earned over 2.3% over an annualized basis, over the past 5 years. The yield is attractive with a short duration while maintaining investment grade quality on average. Capital preservation rose during the quarter due to short mortgage holdings. Finally, the tactical global balance allocation underperformed at 60% stocks, 40% bond benchmark in the 4th quarter. Since the allocation started a quarter with 100% in cash, this strategy did not significantly participate in the equity market rise. But the strategy eventually invested in real estate and U.S. large cap stocks. As presented on the chart on slide 8, the mid-quarter real estate purchases resulted in positive returns for the quarter. As you know, the advanced release of the U.S. 4th quarter gross domestic product, or GDP, numbers were disappointing. After running at a 4% plus pace in the middle of 2014 and between 2% and 4% earlier in 2015, the 4th quarter GDP rose only 0.7%. We are now in the 7th quarter of the oil price decline. But the boost to the U.S. consumer from lower oil prices has not shown up in retail sales numbers. The top left chart presents 2 measures of retail sales: total or headline sales, and so-called control sales that removes so-called necessary sales, such as food, energy, motor vehicles and parts, building materials, and food services and drinking places sales. Both data series indicate that the year-over-year growth in retail sales were lower in 2015 than in 2014. In other words, lower oil prices should have accelerated sales growth, but growth actually decelerated. Given that we have all enjoyed lower gasoline pump prices, what are we doing with that found cash? There are 3 places where the money has gone. 1, we are saving more and paying down debt, as indicated in the top right chart. 2, the bottom right chart shows we are allocating more dollars to housing. And 3, the technology spend has been overwhelming, as presented in the bottom left chart. It is obvious that the U.S. economy will remain slow for a number of quarters to come. Unfortunately, the Federal Reserve maintains its commitment to hiking the federal funds rate by 100 basis points, or 1%. We believe that the Fed's recent interest rate increase and their continuing strident statements implying that the economy is growing at an acceptable rate and inflation is increasing led to the market rout that began in December. Although we believe that the Fed will not be able to increase interest rates at all this year, given economic conditions, we are concerned that the Fed has backed itself into a corner and will be slow to get out, and therefore we are negative on U.S. equities. As you carefully inspect the disclosure page, we will now begin the question and answer portion of the webinar. If you have any questions, please type them in the chat box on the right hand of your screen. We have our first question. Can dividend stocks continue to outperform growth stocks going forward? Well, we think that they will continue to outperform going forward on a long-term basis. The research shows that dividend stocks outperform both value stocks broadly and growth stocks. But recently, the dividend stocks have been hurt because of concerns about growing rising interest rates. Given that, as we indicated, we don't believe that interest rates are going to be rising as far as both the Fed is concerned and in the market, we think that dividend stocks are going to continue to be attractive. The other good thing about dividend stocks is that these are the companies that tend to have the strongest balance sheets. And if we're hitting a time of slowdown in economic growth, then companies with strong balance sheets should be preferred over more growthy-oriented companies. Are there any other questions? Here's one. Is the 50% plus Treasury allocation to post-MPT the maximum level of defensiveness you will employ in these strategies? It depends on the post-MPT strategy. In post-MPT moderate, the most we can have is 50% in Treasury bonds, and we're technically at 48%, so we're very close there. In the case of post-MPT growth, we can have a 67% allocation to Treasuries, so we're not quite at the maximum, but at 58%, we are certainly getting close to it. So again, the quantitative modeling work is very positive on Treasuries versus stocks in the market currently. The next question is, you're negative on U.S. stocks and overall economy for 2016 and up to 5 years. Given that, what is a good place to invest? Well, our negativity should be viewed as just a couple of quarters and not over the long term. We have to remember that over the last 5 years, for the 5 years ending December 31, 2015, that stocks were up over 12.5% on average as measured by the Standard & Poor's 500. That's an unusually high rate of increase over a 5-year period of time. And obviously that was driven by coming out of a deep recession that we had in the 2008-2009 timeframe. So if you look at market history, you would expect that over the next 5 years, that the returns will be closer to the long-term averages of 7 to 9%. So not being ones to predict exactly what it's going to be, we certainly think that we could have high single-digit returns over the next 5 years. Saying all that, that means that you still want to have equity exposure. But our view has been, and if you want to go on the blog on our website, we wrote an extensive piece on this in December, that you're going to want to be more diversified in the next 5 years than you were in the last 5 years. And that's why we're suggesting to make sure that you have certainly the proper fixed income holdings, but also look at the alternative strategies such as inflation protection, precious metals, and liquid alternatives. The next question is, are you negative on domestic stocks to the Fed situation? Although you are negative on domestic stocks due to the Fed situation, what are the opportunities you see domestically in this weaker than expected market? Defensive plays? Yeah, and I would broaden it from defensive plays to plays, if you want to call them that, in which there is a lot of earnings visibility, which is why technology and utilities are both in the portfolios. Utilities, for the obvious, being relatively steady sector, have a sector, and we're seeing good earnings because the inputs for those utilities, which are coal and oil and natural gas, have come down in price. But we don't think it could be, we think in essence you should almost be barbelled, and that you should also have strong technology positions, because there's this big headwind behind technology spending for both businesses and consumers that is larger than the cyclical slowing down that we should see. And that's why we like dividend stocks, because again, they tend to be stronger companies that have earnings visibility and should be able to hold in here if we have any more market decline. And in the meantime, you're earning good dividends. So again, companies of earnings visibility is the areas in which we are focused. The next question is, what's your outlook for gold stocks and precious metals in 2016? It's for 2016, we are positive on the precious metals markets. We think that, and we will be posting on our website in the coming days a piece in our blog, a piece on the gold market. We think that the gold put in an important low in the November-December period, and that it will start increasing again on a strong cyclical basis. Our modeling work doesn't tell us to go out and run out and buy all the gold we can right now, and gold has had a significant move, almost a 20% move from the bottoms back in November, December. But to the extent that gold backs off, it certainly would be a good time to diversify clients' portfolios by having, again, either exposure to precious metals, if you want, the pure exposure, or the exposure to inflation protection, which also has tips and commodity holdings too. And the final question is, please tell me what you think are the three most important drivers of gold prices. Well, certainly one is the in demand from consumers, especially Asian consumers, and the supply itself doesn't change that often. It's almost the exact opposite of oil, in that the supply at any point in time stays the same almost all time, because gold doesn't get consumed like oil gets consumed. So it's really a demand story, and to the extent that there is the continued demand in Asia, which there seems to be, that helps. Secondly, interest rates, because gold doesn't pay a dividend or doesn't pay interest payments. The higher the interest rates, the more the cost of owning gold. And so if you believe the interest rates are declining like we do, then that's another positive for gold. And third, just as a place of safety, I put that in third place because I don't think that's what drives the prices. And right now, people are using utility stocks and bonds as places of safety. But whenever there is a demand for a place for safety, then gold stocks and gold bullion become attractive. So it's certainly a sector that you're going to want to watch this year. But that's all the time we have for questions right now. You can always contact us if you have any other questions that you would like to have answered. I'd like to conclude by thanking everyone for attending our webinar this afternoon. If there's anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We could be reached directly at 800-869-5184. That's 800-869-5184. Again, thank you, and hope you all have a wonderful 2016.